All right. Well, friends, today is the fourth episode of the DSG Global four-part series, and we're going to talk about customs tariff and landed cost and any other questions you may have about the export process. My name is Deep Sengupta. I'm the founder of DSG Global Academy. Uh, the first session we had, we introduced this four-part series, and it started out with identifying your customers, knowing the major export restrictions and legal considerations for the export. Then we talked about export documentation. My colleague Tom McKelvey last week spoke about the various transportation modes. And today I'm going to be talking about the fourth circle right there on customs duties and landed cost. We'd love to take your questions at the end. So please write down your questions or add them to the chat as we go through. Um, you know, why is this subject important? Frankly, many times companies export around the world or they have an interest by the foreign consumer, and the foreign consumer might just receive the product and say, whoa, I never knew the import duties were going to be this high. I don't want it. So usually, the post office or the FedEx, UPS, DHL, what they're going to do is they paid the customs duties on that import. Let's say it goes to France. So they're going to charge you as the exporter, most likely, the import duties if your foreign customer doesn't want to take delivery. So companies like let's say the Amazons of the world, they've got to pay tons of duties and taxes even when their foreign customers reject the shipment. So what we tell smaller importers, who don't have such huge budgets like the Amazons, find out ahead of time what the duties and taxes your customer would need to pay so you can at least give them an estimate. So a lot of companies, what they've started doing in their in their in their carts on their e-commerce website, they will calculate the amount of customs duties and any other foreign taxes applicable. So the product might be worth $100, but let's say, but your total cost might be up to $130, so that there's no sticker shock at the end. We'll also talk about a concept called landed cost, where duties is just one portion of the final bill your consumer will receive. There's many other components which we really recommend you research ahead of time so you can have a better visibility. And the amount of duties you pay really depends upon numbers three and four. A duty is a finite, dollar value, for instance. It could be any other foreign currency. But if your duty is, let's say, $50, $50 really is a percentage of your tariff rate multiplied by the value of the item. And the tariff rate is determined by your harmonized classification. And that determines in the foreign country's custom schedule what the tariff rate should be, the percentage, and the value of your item is the other multiplication factor, which I'll go into in more detail. And through some good legal uh, planning, you could try to minimize or at least not overpay customs duties by doing the correct valuation. And then we'll wrap it up with just best practices. So what I first tell clients is companies that export is, you can't figure out how much to save and, uh, you know, uh, unless you know how much you're paying. For instance, my wife and I say, "Whoa, look at that credit card bill. Uh, let's start saving money." But you don't know how much to cut back unless you know really where you're saving, where you're spending money. And one question that I ask companies is, how much customs duties are you paying currently? And you'd be surprised that over 90% of companies don't know how much customs duties they're paying. That's very strange because if you ask them how much corporate taxes they're paying, they know the percentage, but somehow customs duties is something people just look at the invoice, say, "Oh, looks okay," signs it off and sends it to accounts payable, you know? So what I tell companies is find out, just from like your credit card receipts example I gave, find out from your carrier how much customs duties have I paid? And you can get it divided by country. And they should have all this information, your carrier. Find out how the customs duty is calculated. Is it based on the CIF value, on the FOB value? Is it the duty paid value? There's always a method of calculation, and try to figure that out. And you can figure that out by, for instance, if I said Australia has a 5% GST, you find out from your carrier or freight forwarder or customs broker in Australia, what are the applicable taxes and how are they calculated. Um, Also, see if there's any opportunities for efficiency in duties and taxes, which I suspect why a lot of you are here. Very often, I'll have clients after the call tell me, Deep, I had no idea I could use a free trade agreement. Can you tell me which free trade agreements are applicable to my product, my export, my destination country? And we can try to at least minimize those duties and taxes. So, I first want to tell you about a concept called landed cost. Now, when you ship a product from, let's say, from here to South Africa, what you really need to know, you need to know your cost of your item might be $50 or $100. But in addition to the cost, by the time it arrives in the hands of your ultimate consumer, there are many other charges that you will have to bear. And y'all can agree, you and your customer, who bears these other charges. It could be a customs duty. There could be many other import taxes levied by the foreign country. They're probably known as a VAT, a value added tax in Europe, a GST, a general goods and services tax in Australia, in Canada. The United States has entry fees, very small, they're less than a percentage point, called the harbor maintenance fee and the merchandise processing fee. 0.3% merchandise processing fee, 1.125%, 0.125% the harbor maintenance fee. The custom brokerage fees, your custom broker on the other end, has to do the paperwork, submit your customs entry to the government. And in the United States, they could charge an average of maybe $70 to $150 per entry. Cost of any special packaging, any special handling, the drayage cost, the container loading fee. There are many other costs that we need to figure out what they are. And then there's something known as the international commercial terms. We covered this previously, so I won't go into detail, but the international commercial terms are three letters, 11 such terms, such as EXW, XWorks, FOB for free on board, FCA for free carrier, DDU for deliver duty unpaid. So these 11 different codes, they signify what duties and costs are divided between the buyer and the seller. For instance, if the Incoterm that y'all choose is DDP, that means that all the way to the final hands of the customer, the seller is taking care of all these responsibilities, paying the customs duty, taking care of the customs broker. But if your term is a C term, like CIF, that means the buyer will take care of the ultimate destination cost and also the custom brokerage fees and paying the customs duties. So the Incoterm kind of determines the allocation of costs and responsibilities and also the risk of loss. So what I tell consumers is clients is the top 5 ways to minimize duties and taxes. And duties and taxes, depending upon how well you plan, depending upon which countries you send to, it could be 5 to 10% of the cost of your goods. You know, uh, there's a study done by the World Trade Organization, and they found that developed countries, that's more industrialized countries like US, Canada, Europe, Australia, they traditionally have lower customs duties because they've seen that having lower customs duties is less of a barrier for international trade and spurs international trade. So companies with higher GDPs, gross domestic product, they actually have lower customs tariffs. But countries that are poorer, or shall we say less developed, less industrialized, many Asian, many South American, African countries, what they do is they rely a lot on um, customs revenues for their functioning of the government. So they have a very high customs tariff. And what it does is it does protect local industry, but it is a disincentive for international trade. So companies like Brazil, India that have double digit taxes, it's really not spurring international trade. So find out, what the tariff uh, duties are for your destination countries. And it starts with, like I said, the HTS code, which is the classification, and the value of the item. Also check if there's any free trade agreements in place. Now, the United States has free trade agreements with over 20 different countries. And if you shipped a product that was a product of the United States or eligible under the US free trade agreement with that country, it would be duty free. For instance, US has free trade agreements with Canada and Mexico. It used to be known as NAFTA. Now it's called USMCA. We also have free trade agreements with the Dominican Republic and the Caribbean countries, with AGOA, many African countries, Chile, Bahrain, Jordan, Singapore, Australia. So there's a lot of free trade agreements. So if you're shipping to a consumer in that country, figure out if your goods qualify, which means they're eligible, and also see which documents may be needed to show the foreign customs or the other end that your goods are eligible for duty-free treatment. Now let's talk about the harmonized structure. The HTS code, as I said, determines your customs duty rate. So how do you figure out your HTS number, and what is HTS number? The H in HTS stands for harmonized. And in the US, HTS stands for the Harmonized Tariff Schedule. In India, they call it HSN, Harmonized System of Nomenclature. Most European countries call it the Tariff Code or HS Code, which is Harmonized System. So before 1950, different countries had different codes and different customs duties. So most countries sent a representative to Brussels back in the 1950s, and they came up with a 3,000 page document, which in 22 sections and 99 chapters pretty much listed all the products that were in existence back in 1950. It's a pretty hilarious document because you'll see that computers are not called computers, they're called automated data processing equipment. That's under chapter 84. But every 8 years, the World Customs Organization does do a rewrite. They look at obsolete product. They look at new technological innovations like Wi-Fi devices and so on and so forth. And being based in the West Coast, I love interacting with customs and telling them about my clients' new products. And it's amazing how customs tries to pigeonhole these new technologies into old codes. But anyway, they update it every couple of years. And what you've got to do is figure out your product's 10-digit code, and that will determine the customs tariff duty. And how do you do that? So the tariff schedule is divided into sections. Figure out the section that applies to you, animal products. And then what you've got to do is really look at the tariff. Sorry, we start out, there's 10 digits. The first two digits would be the appropriate chapter. The next two digits would be the appropriate heading. Then there's the 6-digit level, the subheading. And then at the last 4-digit level, I call it the statistical suffix. Now, most countries around the world have the same common first 6 digits. That's why it's called harmonized. But the last 4 digits are usually different for each country, and they're country specific. For instance, I was advising a a very well-known wine company in California, and we were classifying their products for the US tariff. But we noticed that when the products were being sold to some Middle Eastern countries, at the last 4-digit level, it was pretty much red wine and white wine. But France, on the other hand, might say, well, Petit Syrah, Chenin Blanc, a Riesling. It might go a little more in depth based on how sophisticated their local market is. And if you use just your US code, which is the 10-digit US code, and send your product to a foreign country, the foreign customs broker will recognize the first 6 digits, but at the last 4-digit level, they'll be scratching their head saying, this is probably a US last 4-digit, but our country has different last 4 digits. And I don't know which last 4 digits of my country's tariff to apply. So guess what they do? Obviously, they choose the code for their country that has the highest duty rate at that last 4-digit level. That's why I tell companies, if possible, try to research your destination country's harmonized code. So even though you know your US code, finding out the code for Thailand, Chile, Brazil, or India, or Mexico will, number one, ensure you pay less customs duties and also that there'll be less delays. So this is what a US harmonized tariff looks like. You'll see the first 2 digits, 42 is articles of apparel. 4203 is articles of apparel made from leather. And then 420330 is belts with or without buckles. And then if you go further down all the way to the 10-digit, you can figure out what a belt made of reptile leather would be. So, it's kind of going down the list. There are 3 rates of duty, 3 columns. The general, and this is a misnomer, they call the general rate around the world, it's called the MFN rate. It's called the most favored nation rate. But you'd imagine most favored nation means most favored nation, but it's not that. Most favored nation is the normal rate that that is applicable to every country. So the spirit of international trade is unless there's a free trade agreement, all countries should get the MFN rate. It's called the normal or the standard rate or the most favored nation rate. In this case, if it's a belt of reptile, every country that sends such belts to the US would have a 4.9% general rate of duty. But if it's from a column two country, which is a country we don't like doing business with, like Iran, Russia, Cuba, all these embargoed nations, we're going to charge a punitive 35%. Why? Because we're obviously trying to discourage trade with that country and we're trying to punish that country in a sense due to some geopolitical economic policy. Recently, just last week, the US trade representative announced some punitive tariff rates on Chinese origin goods starting from 2025, next year. And during President Trump's administration, we call it the Trump tariff, there was some additional 25% punitive tariffs on articles from China. Uh, some of those articles in under the Biden administration last week has been increased to 50%. Mostly it's for EV vehicles, also some sort of semiconductors and machinery, no food products, but just goes to show how there's a general rate and then there's a punitive rate, which this 35% is. Now there's something called special in column one, and they say free for A, CA, E, IL, J, and MX. Now all these letters are suffixes and abbreviations for free trade agreements. So what this is saying is that if your product is A is a NAFTA country, CA is Canada, E, I don't know, I need to look that up. IL is Israel, J is Jordan, MX is Mexico. If your product is a eligible item from these countries, eligible means it's really got to be from that country and it's originating from that country. It just can't be flyby passing through that country. Then you'll get a duty-free treatment if your item is originating in those free trade agreement countries. So why is determining your correct classification important? Because you can figure out your rate of duty. You can figure out whether your items are eligible for any free trade agreements like NAFTA, now known as USMCA, or any of the other free trade agreements I mentioned. Many countries also have anti-dumping enforcement actions if they feel goods from a particular country are being sold at less than market price to flood the market. So then those countries may apply an anti-dumping or a countervailing duty. And many times the health departments or other government agencies like Food and Drug Administration, Fish and Wildlife, Department of Agriculture may have some special requirements and documentation required, and they figure out uh, its applicability on your product based on the HS code. So if your HS code, as we said, is 4203 articles of leather, they'll say, well, we need a clearance from Fish and Wildlife so that we know that that reptile is not an endangered species, right? So that's the reason for accurate classification. Um, Also, try not to cheat the government because it does catch up with you. There's many cases of fraud where we hear the government's got a high tariff on some sort of fish, and companies will misclassify their items, just to avoid that rate of duty. But eventually, there's government auditors whose job is to find out who's cheating the government. And a mistake here and there could be negligence, but then the government might issue penalties if this happens again and again for gross negligence or willful fraud. So, try to get your classifications accurate. Common errors is obviously if the description of your item is not complete on the commercial invoice, then your customs broker on the other end wouldn't know how to classify it correctly. So an incomplete description usually leads to an inaccurate HTS classification number. Many clients, many companies are also a little lazy because they wait till the last minute when the goods are getting out of the door, and then they have the shipping clerk come up with the harmonized code. Just before the 4 p.m. FedEx pickup. So very often the shipping clerk does other, not elsewhere specified or indicated, instead of choosing a more accurate, well-researched HS code. So how to arrive at a correct classification? Collect all the information about the product, go down the list of which category, which section, which heading it should be in. And there's something known as the general rules of interpretation. I'm going to cover that in the next slide. But it's very important that you'll know that customs uses these GRIs in order to come up with the correct classification. And the harmonized code for your chapter, for your product, also has section notes and chapter notes of inclusions and exclusions, which you should read as well. These are the GRIs, called the General Rules of Interpretation. Basically, every importer who assigns a HTS code for their item needs to be aware of this and follow this. Or your customs broker could do it. I'm sure they're aware of this. GRI 1 means by name. If your item, roasted peanuts, is listed in the customs tariff by name, roasted peanuts, then you've got to choose that. And you've got to choose that customs classification number. And your rationale for choosing that, if questioned, is, well, we use GRI 1. Suppose your item is kind of an incomplete version of, I can't think of a food product example, but of a finished item, but it's an unfinished, incomplete version. Under GRI 2A, if it pretty much looks like the finished item and has the essential character, it will still be classified as the completed item. GRI 3 is very common among my clients because there's no one code. There could be 3 different codes. And under GRI 3A, I'll say, if there's a couple of different headings that could apply, choose the one that is most specific over a general heading. If it says hand tools, or if it says electric screwdriver, you obviously go with the electric screwdriver rather than hand tools, which is a broader, more general heading. I really like, I've used GRI 3C a couple of times. What this says is, if there's several headings which could equally apply to your product, choose the one that is last in numerical order. So I've used that a couple of times. And there's a couple of other headings, containers, packing material. These are different GRIs. These are the rules of interpretation. So friends, if you have many items that you sell around the world, I would highly recommend come up with the most current. because it changes every couple of years, at least every 4 years. Take a look at your harmonized codes and verify that those codes are still in existence in the US government harmonized tariff schedule. Um, Check that, if possible, if you're shipping to a foreign destination country, find out if there's any free trade agreement you could be using. Find out what customs duties you're paying for any destination country, and figure out who is determining the harmonized code for your items. If it's always a third party, like your customs broker, don't rely that they're doing a good job. Verify. Maybe many third party service providers say, hey, we just relied on the incomplete information you gave us, because they've got literally a couple of seconds to look at your commercial invoice and figure out what it is. And nobody knows your product better than yourself. Now, the US government on any export above $2,500 per line item um, requires you file electronic export information called EEI. And you've got to file one EEI per Schedule B if the value of your export is more than $2,500 per Schedule B number. Schedule B number looks just like the harmonized code for the first 6 digits. Usually at the last 4 digits, there's a lot of zeros because the reason the US government uses a Schedule B number on export is to keep trade statistics. So when they do their trade negotiations with different countries like China, they know exactly how much rice we're exporting to China, or wheat, or soybean, because they have companies who export, uh, submit this information. So that's also another number that you may encounter. But try, if you're a frequent exporter, try to figure out the foreign country's HS code. I really recommend that. Fewer than 10% of all companies do this because it's a little more time consuming. And there's various databases out there that provide this information for the foreign country. But you can, if it's an English speaking foreign country, you can find out by going to the foreign country's website and figuring out what the foreign country's HS code is for your HS code. And like I said, the first 6 digits will be the same, and then you can just drill down and figure out, let's say, Brazil's HS code. Uh, you know, Tips to avoid clearance delays. Now, I used to work for FedEx and manage their consulting practice before I started DSG Global Academy 10 years ago. And we noticed from a lot of caged shipments. A caged shipment is a product which is held for various reasons. And these are the top tips to avoid clearance delays. Number one, complete all your documents correctly and consistently. Because if there's something inaccurate or incorrect or inconsistent across the different paperwork, it's going to be held up by somebody who's reviewing it. Obviously, legibly, list each commodity separately, providing a detailed description. Provide the correct HS code and, if possible, the country specific HS code. The commodity's country of origin is also very important. And if the customs broker or the customs official has any questions, give them a contact number that they can call, ideally in the country that they're based in. So your phone number and the buyer's phone number in the destination country would really be helpful. So customs can say, hey, this item says Panda Bear. Is that a brand name or is it, what is it? So many times companies give names to their products of animals, and the Fish and Wildlife says, hey, wait, is this just a name of a cartoon character, or, you know? So we talked about the tariff being determined by the tariff rate, which is found in your harmonized tariff schedule next to your tariff number. But also your customs value will determine how much duty you're paying. Now, 5% customs tariff on $50 is a lot less than on $100 or $200, right? So what we've noticed is that in countries where you have high customs tariffs, there's a general propensity for importers in that country to kind of declare lower values to customs. Now, if they do it correctly, it's one thing, and I'll show you how to do it correctly. But if they do it just to avoid customs duties, that's illegal and criminal. And you should never cooperate with a foreign buyer who says, can you please lower the value on the commercial invoice so I pay less value? Uh, Now, the declared value, there's 6 different methods by the World Customs Organization. That's, signed by, over 150 countries. And these are the 6 methods that you should be using in sequential order. The most common is the sales price of your item. It's also known as transaction value. If you don't have a transaction value, why would you not have a transaction value? If you don't sell it, you won't have a transaction value, right? If your goods are sent for research, as a sample, as a consignment, um, as a gift, it won't have a transaction value. Then customs says use the following 5 methods in order. A transaction value of an identical merchandise, then if there is none, a similar merchandise. Now, 4 and 5, deductive value and computed value, you can use interchangeably. Deductive value means you take the sales price and you deduct certain advertising marketing expenses. Computed value means you take the cost price and you add a certain notional profit. And still, if you can't come up with a value, um, then you use any other method that you can come up with that's based on general accounting principles. Usually, my clients who use the 6th method, which is any other method, is usually when it's a depreciated good, it's an old item, so you could do a straight line depreciation, or it's the value of scrap. Cell phones which are defective, how do we value it? It's like useless. Well, what's the cost of the scrap and the precious metals that you get after you burn it down? So, it's kind of a unique way of coming up with the value if none of these other methods are applicable. Let's go through these methods quickly. The transaction value, which is the sales price, is usually 95% of all customs values is this. How much did you sell your bag of wheat or your smoked salmon to your customer? We sold it for $100. Okay, that's the customs value. Sometimes companies, they say we did not sell it, or we sold it to a related party where our relationship has influenced the price. So if your relationship between the 2 related parties has influenced the price, then you can't use transaction value because it's sold at a discount. A related party means another subsidiary or a parent company or a company where you have common ownership, common directors. So it's kind of a sweetheart deal. So customs says, no, you gave a huge discount. So what do we do then? You do an arm's length price, or you, and here's where not to use transaction value. When there is no sale, or you can't come up with a value, or there's a related party where, the relationship has influenced the price. And the next method is, well, in that case, I don't care that you didn't have sales price. Customs will say you still need to pay customs duties. I can't tell you the number of times companies have told me, why am I being charged customs duties? Because there was no sales price. There's no sale. Well, I'm sorry. Customs charges on the price of that, the value of an identical merchandise, even if there was no sale, sadly. So customs will say, well, what's the cost of this on the street? They'll do a search on Google and say, looks like this normally sells for $30. So we're going to put that as the value. So even though you aren't charging for that sample for the trade show, customs is still going to charge based on the value of an identical merchandise. If you say, well, my product is so unique, there's no identical merchandise out there, well, then customs will look for something that's similar, a similar merchandise. What is that value? And then, if none of those three methods work, we look at, as I mentioned, the resale price, taking certain deductions for marketing expenses, or we take the computed value, commonly known as cost plus. So many times, what companies will do is they will pay duty on their cost price, but that's actually inaccurate. It's got to be cost plus a certain profit margin. Whatever is normal in your industry, 10% is a good rule of thumb. And if you still can't come up with a value that under those five methods, come up with your own method that is based on general accounting principles. Common valuation errors, you know, um, just putting a $5 value or a $10 basic value, no, or a $1, there's got to be some method to that madness where, oh, because it's a RMA or a repair shipment or a return or a sample, that's not good enough. Customs has rules, and you've got to come up with a valuation for your item so that you don't get a bad reputation and your goods don't get held up. I know that this is not applicable to food producers, but software is another tricky subject. There's also a concept called assist, which is a very tricky subject. And assist means if you, as the importer, have actually provided your foreign manufacturer with some free or discounted raw materials, and then when you get the goods from the foreign manufacturer, you need to add on the cost of the discounted product you provided onto the value. That's called the value of an assist. It's a little tough to understand. It's not counterintuitive, but customs usually ask these questions. Okay, you imported it for $100. Did you provide any raw materials? Yes. Did you provide any molds, any R&D cost, which you didn't charge for? Yes. Well, then add that value of that assist to the value of the import and pay customs duty. So, and finally, companies that only declare their cost as customs value, as I mentioned before, that's only in the fourth method, computed value, and you've got to declare cost plus a notional profit margin. Best practices, if you are shipping overseas to many countries, figure out the valuation policy for different scenarios of import. When in doubt, you can always ask the government or the Foreign Customs Agency for a ruling, and work closely with your tax department so that there's a consistent transfer pricing policy. Transfer pricing means when you have um, subsidiaries around the world and you need to accurately declare the cost of the goods, not just for income tax and corporate tax, but also for customs. So it helps to align um, your valuation methods that you declare to customs with that your company declares to the tax authorities for corporate tax. Friends, today I think I've discussed customs duties and customs valuation a lot. This was the fourth and last component, but I'm delighted, as I mentioned to Busara, to offer a free consultation to any of you if you all have any questions on the international export process. So, as a summary, find out your HTS codes. There's a typo right there, it should be HTS or your harmonized codes. Find out how much duty rate you're going to pay in that country and research the other charges so you know what your landed cost is so that you don't get a surprise. If you don't have a presence in Europe, you're going to face about a 20 to 25% VAT in Europe, which you can't claim back unless your customer or you have a um, agent who's VAT registered. Check eligibility for any free trade agreements based on the countries you're shipping to, and check your foreign country's import requirements before you export it out of the US so your goods aren't held and languishing in a cage because you know because of some paperwork snafu. And of course, get your valuation correct so you're not underpaying or overpaying customs duties. Friends, I'm delighted to take any questions right now. And once again, uh, DSG Global Academy, we're thrilled to answer any of your questions now or later.